Glenn Silverman from Investment Solutions joins me in studio. Glenn is the Global Chief Investment Officer and he's here to talk to us about his global equity fund. And of course, Kevin Links from Stanlib still in studio with me. Glenn, thank you very much for joining us. In the introduction, we highlighted to viewers that you've got a stance on Japan, and perhaps we should start there before we delve further into the global equity fund.
So I think, Bronwyn, just important to point out, we're a multi-manager, we're a fund of fund manager,
Absolutely.
If you like.
You
so
allocate to fund managers.
We give them to fund managers and it's their decision whether or not to be in Japan or not. So we have 6 underlying managers in the main part of our fund, our World Equity Fund, and they actually have very, very controversial and differing views. So it's really great when you find different managers with different styles who all end up with the same view, end up with very bold positions. Currently, that's not the case. So we have some managers exposed to Japan and others who say they can find absolutely no value there at all. So whilst our fund is kind of broadly neutral to Japan, there are other themes out there. When we speak to the managers about Japan, it's fascinating to listen. One of our particular managers says he has no exposure to Japan, cannot find anything he likes, and so he keeps going back to Japan to visit to find out whether he's doing something wrong. And he says he still hates them and he buys nothing.
Glenn, if you put all of these fund managers together, then you obviously end up with a composite.
Yes.
And when you look at that composite, how does the fund end up being biased geographically? Is there any bias that comes through, or does it end up reflecting more the index, and so you take in your bets, if you like, on the stocks specific stuff? Or is there also a geographic bias?
So first of all, we have certain philosophies. Our philosophy is to find pretty aggressive managers who don't sit with thousands of stocks, but typically between 50 and 100. So they're stock pickers. You're talking about a universe of, 36,000 global equities out there, so there's lots of them. So even picking 5 or 6 managers who hold 50 or 60 or even 100, you're picking a very small proportion. So we're going to have quite big bets against an index. So we always have tilts. The tilts are always in place. We have it at sector level, we have it at regional level, obviously at stock level. The biggest tilt that we see now by far is we have a benchmark which is MSCI World, that's a developed market index, and our managers are taking quite an aggressive bet away from America, but a 10% negative bet on America or towards emerging markets.
Okay.
So that seems to be the biggest thematic.
So that emerging market is then an off-benchmark bet, as you like.
Correct.
And within emerging markets, are they playing a general pool of emerging markets, or is it biased towards, say, the Asian region or South America?
It's a fascinating thing, and I'm going to answer that in 2 parts. It's not only this 10% bet that they've taken there. Even those managers who are not buying those emerging markets specifically are buying companies who have very huge exposure, earnings, revenue, etc., to emerging markets. Some of them say as high as 40% of their portfolio is actually exposed to that region. So I mean, Kevin could probably say it better than I, reasons why one would prefer to be out of the West and all the problems and debt that we see there, and a much better structural, fundamental economic bias there. But our managers are not taking top-down views. In each and every single one of these cases, they're buying shares that they like. If they happen to be in Bulgaria, they happen to be in Australia or Ukraine, it comes as a consequence of bottom-up stock selection.
Just a moment ago, we were with Rolf Alberts talking about value versus growth and the gurus in that space. Do you have a clear bias when it comes to your managers right now? Is there a clear growth or value bias?
So it's very interesting. Broadly, traditional multi-manager tries to be neutral as best they can. You have people in the middle, the market-oriented or often GARP managers, and then you find some deep value and deep growth managers. And we try to maintain a broad balance there. Typically, one prefers a slight bias towards value. Value managers do tend to outperform over time. And then if we think we can see something, a stronger signal that might come through, and that comes through various aspects. And we find, for example, managers that have outperformed very, very strongly, we tend to look to take money away from them. Managers who we think are great quality managers who have stuck with positioning that hasn't worked, we try to give money to them. So we have a more strategic view of a more balanced portfolio with a slight value bias, but then we take some tilts around that to try get added performance.
Glenn, if you look at the performance of many equity funds, international funds that have been, whether it's developed or even emerging market, and you translate those returns into rands, the performance hasn't been great. Yep. And so it hasn't been a fantastic investment in effect to go offshore. Are you more optimistic now, or what is your general advice that you're giving to potential investors about using an offshore product?
I think it's just a very, very good point. I mean, we love to say to our clients, please diversify away from South Africa. And I always say, but look at the last 20 years, we've done so much better being in South Africa. And that is true looking backwards. One would suspect that probably won't be true going forward, but the exact timing thereof is not sure. The rand is strong. we have a very strong view that the West has, and now you've been talking about it earlier, debt problems and other problems which we think those are going to keep coming back to the fore. But notwithstanding that, at some point in time, we're a small country, southern tip of Africa. The currency is arguably expensive to quite expensive, and we think over time you do need to have that diversification. So our suggestion is still take some money overseas, and then you say which asset class, because the rand has been strong against all asset classes. So they've muted the dollar returns or overseas currency returns in every single asset class. And we think equities are probably about the most attractive asset class out there. We've actually got two broad equity funds, the one we're speaking about now and another which is a much more flexible fund. And it's actually the one that I favor, where we've found
the flexible fund.
The flexible fund. 10 underlying managers throughout the world, some in Asia, some in Europe, in the States. One happens to be South African as well, it so happens, who actually plays a flexible asset allocation. So we think these guys have the ability to decide when to be in equities and when to be out of equities. The rand is going to impact on them similarly because we've got a rand denominated fund at the end of the day. So the rand will impact, but at least they have the ability to call the asset classes.
So let me just clarify. So in your offshore offering,
yes,
where you are selecting the fund manager, you are purposely selecting emerging market fund managers as part of that mix, or is that not the case?
So in the first fund that I spoke about, our global equity fund, in all cases we pick and manage the global equity mandates. They have discretion to buy pretty much as much emerging markets as they would like. We tend to find they don't do that very much. I mean, managers would take 20, 30% bets against benchmark. That's pretty bold already. Very few would take a much greater bet. We have no emerging market equity managers.
What I'm trying to get to, sorry, I'm taking up the show.
No, it's fine. I'm giving you a little bit more time because I was very harsh on you in the last one.
Oh, thank you very much. What I want to understand is that you do a huge amount of manager selection, so you start to understand investment managers very well. When you go and look, I'm just saying hypothetically at India, let's just use that as an example, are you finding that fund managers are coming to the fore out of India where you say to yourself, there's a great fund manager, I'm going to put this guy into my portfolio? Or are we not at that point yet, where you're still selecting basically developed market fund managers?
Yeah, it's a very good point. And at this point in time, they're all developed market managers. Typically, we find still the predominance is in the States. Finding quite a few, obviously Great Britain, including Scotland. I mean, found some excellent managers there, and then to continental Europe. So I haven't yet done a trip to find any Indian managers or kind of, I don't know, Asian Pacific-based managers, etc. I suspect there would be good managers there, but managers with the type of track record that we look for, etc., we actually haven't come up with that many outside those regions.
Glenn, thank you very much for your time. And Kevin, thank you for allowing me to take a back seat in this interview and observe from my position here. What I may do is sit there next time and allow you to sit here so that you can't cut in.